Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for the week of July the 9th, 2012. The optimism from the EU summit faded quickly and sentiments turned 180 degrees last week. Spanish yield jumped back above 7%, indicating that markets were still concerned about the Eurozone situation despite all the announcements from European leaders. Triple shot actions from world central banks provided no support to market confidence as risk markets were sold off sharply. Steep decline was seen after release of worse than expected employment data in the US. Commodity currencies followed stock and weakened broadly against the dollar and yen. Nonetheless, European majors were even weaker as the Euro-Aussie dollar dived to a new record low, while the Euro-US dollar dropped to its lowest level in more than a year. The dollar index jumped sharply to close at 83.37 and is now looking at breaking near-term resistance of 83.54. Global economic data released pointed to a deeper slowdown ahead. From the US, non-farm payrolls showed a mere 80,000 job growth in June compared to an expected figure of 90,000. The total figure for the second quarter of 2012 was only 225,000, just a third of the 677,000 seen in the first quarter results. The unemployment rate was unchanged at 8.2%. The US ISM manufacturing index unexpectedly dipped into a contraction region of 49.7 in June. ISM services indices also disappointed by dipping to 52.1. Eurozone PMI manufacturing was at 44.6 in June and services PMI was at 47.1, both in deep contraction. UK PMI manufacturing improved to 48.6 in June but stayed in a contractionary region below 50. PMI services came in weaker than expected at 51.3. Canada's IV PMI also dropped below 50 to 49 in June, and China's official PMI manufacturing dropped 50.2 in June, the lowest figure in 7 months. The IMF's managing director, Christine Lagarde, said that the organization will cut global growth forecast this year and economic outlook will be tilted to the downside. Though Lagarde qualified the statement and said that tilted means there's not an enormous variation, even though it is negative. In April, the IMF projected 2012 growth to be at 3.5%, while 2013 growth was projected to be 4.1%. That was an upward revision from January's estimate of 3.3% in 2012 and 3.9% in 2013. But it's believed that recent development and economic data has prompted the IMF to lower the forecast again. Lagarde also pointed out that if there was a further deterioration arising out of the Eurozone, it might have an unwelcome currency effect on the yen, which would be used as a safe haven and therefore would become further overvalued. The rate cut from the European Central Bank and the People's Bank of China, as well as the Bank of England's asset purchase programme expansion, provided no support to market confidence, but rather they're seen as a sign of deeper worry from central bankers. The ECB cut the benchmark interest rates to a historical low of 0.75%, and more importantly, the deposit rate is now at 0%. Comments from the ECB President Draghi were overwhelmingly cautious as he noted that downside risks to the euro area economic outlook have materialized and the bank doesn't see risks for inflationary expectations. Draghi warned that Q2 indicators pointed to a renewed weakening of economic growth and heightened uncertainty. With deposit rates at zero, markets are already speculating that there could be another round of long-term refinancing operations in September, and the ECB could eventually adopt quantitative easing. Another important development was that the ECB said nothing, providing no hint on supporting the peripherals. There was no talk about using the European Stability Mechanism to buy Spanish and Italian bonds. In addition, Finland and the Netherlands have openly expressed that they will block using the ESM to buy government bonds in the secondary market. The stance was further reiterated by the Finnish finance minister, who said that the country will not hang itself to the euro at any cost, and they are prepared for all scenarios. She further added that collective responsibility for other countries' debts, economics and risks is not what they should be prepared for. The Bank of England left the benchmark interest rates unchanged at 0.5%, but expanded the asset purchase programme by another 50 billion GBP to 573 billion. The bank noted that business indicators showed continuation of weakness in the economy in near term, both at home and abroad. Also, the central bank remained concerned with the indebtedness and competitiveness of several euro area economies, which weighed down on confidence. The Reserve Bank of Australia expectedly left the rate unchanged at 3.5%, following two consecutive cuts totaling 75 base points in May and June. Governor Glenn Stevens saw growth in the country during the intermeeting period and anticipated inflation to be in line with the target. Notwithstanding uncertainty and potential downside risks in the global economy, the central bank believed the monetary stance is appropriate. In China, the People's Bank cut the benchmark interest rates for the second time in a month. The one-year lending rate will be lowered by 31 base points to 6%, while one-year deposit rates will be lowered by 25 base points to 3%. Also, the central bank said that banks are now allowed to offer 30% discount to borrowers, up from the prior 20%. Nonetheless, they urge banks to continue to strictly implement the differentiated housing loans policy and continue to curb speculative home purchases. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, please join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.